Hi, I'm Miko Neiman. I'm with Century 21 Hometown Realty.
And I'm April Hugh. I'm with Century 21 Hometown Realty. And today we have Lee Carroll CPA.
Hi.
To join us and talk about some tax information.
Exciting.
Yeah.
Welcome.
Thank you. Appreciate the invitation.
All right. So Lee, how long have you been a CPA?
I've been a CPA. I passed the exam in 01, and I think I got certified in 2003.
Okay.
Was doing taxes before then, just help, on my own time and whatnot, and then I moved out on my own in 2005. The beginning of and after tax season 2005, I moved out on my own office, and been there ever since. Yeah.
All right, and that's in Old Orcutt.
Yes, kitty corner from the post office. I look out my window at the post office.
Nice.
Right.
All right.
So when you have a buyer that is interested in getting in the market, do they ever call and go, hey, what do you think? Is it going to benefit me? What are the benefits? What should I think about? Do you ever get those kind of calls?
Occasionally. I mean, if I get a call about property, I'd probably refer them to one of you two. But from a tax standpoint, people do call and ask, because lots of folks don't really understand the ramifications of what a house purchase will do, or whether it'll benefit them or not. So I get those questions occasionally, yes.
Occasionally, but more so maybe on the selling side?
Definitely on the selling side.
Yeah.
So, but back to the buying side. So if someone does buy a house, what is a tax benefit for them to have on their taxes to be a homeowner?
Well, from a personal standpoint, or an investing standpoint, from a personal standpoint, sticking to personal is, it's going to be the tax deductibility of mortgage interest. And then up to $10,000 now of taxes that we pay each year, and other than that, from a personal standpoint, that's going to be basically what you're going to have. There's not a whole lot anymore. It used to be, we used to have a lot more, especially here in California, with regard to the taxes that we pay on them. But now it's capped at 10 grand. So it's still worth it, though.
Still a good investment.
Yes.
For your personal residence.
And the appreciation that we're experiencing right now is phenomenal. So
I have a client that's a broker like you guys, and I did her working on her stuff right now, and I'm happily surprised for her, pleasantly surprised. She's done well.
It's been boom.
Good year.
Yeah, it's been kind of unheard of, especially during this COVID time. It's we're I guess blessed that we've managed to stay busy.
Yes.
So
Good.
So now, as far as an investor, what if someone's wanting to buy and invest in properties? Do you have any advice for someone looking to do that as far as?
Well, if there's from like a first-time buyer or a client of mine that's looking, just not necessarily doing it for a professional real estate investor, but from one of us, a normal guy.
Yeah.
My thing is, I think make sure you pay down your debt. And don't go in, because a lot of people think they're going to go in and they're going to buy a house and they're going to make a lot of money. Hand over, it's just going to, and that's not what I have seen. I've also been told and looked into and advised, don't buy a fixer-upper unless you are a contractor or you're married to a contractor. It's like, because it's just not worth it. And one of the other things is beware of their interest rates, which you guys will help them with as well, or Kate Ferguson or whomever you guys might work with. But the people that deal with the mortgages, be careful of those interest rates, because it's a long-term contract, and
And they're higher for investors versus for an investment property versus a personal residence.
Now,
that's true.
Can you talk a little bit about depreciation and that sort of thing with an investment property that?
Well, now from an investment standpoint, most people, especially in the beginning of investment, are going to, here in California, are going to lose on paper, for tax purposes, are going to lose money on paper. So it becomes a good investment because it decreases taxable income because of depreciation. So if you got the house, it's the home here, now you can't depreciate the land, so you got to always, and usually, you take a rule of thumb, at least from an accounting standpoint, 80-20. 80% is the building and 20% is the land. That might be a little bit, but it's acceptable. Not for a condo. For a condo, it's the condo that you don't own the land. You only, as you guys know, so it's all deductible there. But so the depreciation is 27 and a half years, and you divide it by, or you can also do it sometimes if it's depending on the length of the loan. That makes a difference too. So.
Okay.
So the more you can depreciate, the better off you're gonna be,
Correct.
because you only have a limited number of years to
On
do
paper,
that.
on paper. But the thing to keep in mind though too is that when you sell the property, you recapture the depreciation and pay normal tax on it. So it's not like free money. It's free now, and it's good from the standpoint of the time value of money. You know, you get to make more now or deduct more now, but later on it catches up. It's still a better deal for an investor to be able to do the depreciation. And the key thing on depreciation, some people don't know. They think, well, I won't take it, then I don't have to recapture it later. IRS doesn't care. It says could be depreciated or could have been depreciated. So even if you didn't take the depreciation, when it comes time, you have to act as if you did. And I grant you, most people don't want to. And I mean, I couldn't do it as a CPA. I could lose my license. But if they did their own taxes and just said, "Oh, I'm not going to do it," and they got audited, they're going to have to pay. Yep.
Okay.
So then maybe also it would help because you would be in a different tax bracket later, so it might not be as bad maybe?
Correct.
Yeah.
That's true.
Plan
Yep.
that type of thing.
Yep. That's a good point.
Yeah, okay,
All right.
okay, great.
Now, as far as selling, you know, with the capital gains, you know, say it's their personal residence or primary residence or a couple, and they're worried about capital gains. They own their house free and clear, and they bought it 30 years ago, and say they're going to net, you know, over $500,000. So how does that work?
Well, over the 500, pardon me for jumping, but over the 500, I can't believe it's going to be much over the 500. And so the good news about that is that they can deduct the fees they pay you, and they can deduct some of a lot of those escrow fees are deductible. So, and if they're selling a house that's making more than $500,000 on the profit, then it's going to be at least a $500,000 sale, and commissions are going to be what, 25, 30 grand right in there to each buyer and selling agent. All of that's deductible. So if they sold it for $525 and they paid, and their basis was zero, and they paid, there's still fees that we can deduct to get it. But where you're going with that 500 though is that we still have a married couple has that exemption of $500,000 on a personal residence, which means you had lived in it for at least 2 of the past 5 years. It doesn't have to be the 2 straight, but 2 of the past 5 years. And a single person is $250,000. And you can do that every couple years, every 2 years.
Okay, so
And there are, I don't know if I can, there are exemptions to, I had an Air Force client that that bought the house and then moved and, or was reassigned. And so there are instances where you can take a percentage. Let's say it was 18 months they lived here, so they get 75% of the $250,000 exclusion. Yeah, but there are parameters. I don't think it's just any of us can do it. You have to, like in his case, it was a work-related reassignment.
So there are
Beyond
exceptions.
there are exceptions. Yes,
Okay,
yes.
Very good.
Divorce.
Yeah, I don't know about that one. I don't know how that. Yeah, I've never seen that as an exception. The IRS doesn't care, huh?
Yeah. Right. Okay. So then, as far as investors, of course, if they're trying to avoid capital gains, because usually that's for an investment property, if they don't live in the property, then they're going to be taxed when they sell it if they make a profit.
Correct.
And what usually is that percentage?
Well, it depends on their tax bracket at the time, you know. But and the avenues or the strategies for the investor would be first to look at a 1031 exchange, which you guys probably deal with, which is an entirely different niche. For guys like me, I wouldn't do a 1031 exchange return necessarily. I would hand it off to a CPA that does specifically. And there are people, I bet you guys know what I'm talking. There are specific companies that only do 1031 to make sure they get it right. But it's still it's an opportunity. And the other thing is tax loss harvesting, which means if you have some other properties that you're going to have losses on, even if it's stocks, you know, or whatever. If you have other things that you've been holding on to forever because you don't. And well, that might be the time to sell those so that you have that a capital loss over there and you can offset it with your capital gain over here. Gotcha. And it nets out. You got rid of the junk stock or whatever it was that you had. And then the other one was, which I've had happen a couple years ago, one of my clients, is that you move into it. You can, remember, 2 of the past 5 years. So the client could move into it and live in it for 2 years. And then, or the investor could move into it and live in it for 2 years. And then they'd be eligible for that exclusion. So.
Very good. Yeah, those are some good tips.
Yeah.
All right. And let's see.
You were going to talk about your client with
Oh, Jimmy. Jimmy, the foreign,
Did she call you on that?
well, I've never had it before where there's someone that, one of my clients, he doesn't live in the United States. He doesn't really speak a lot of English, but he bought a property 7 years ago with cash and wanted to sell it this year or last year. And he, we got down kind of to near the end and he goes, oh, well, with the escrow officer, how are we going to disperse the money, and all of that came up, and he didn't have a social security or both, there was a lot of complications with his situation. But I'm like, okay, I don't know. So Jennifer, the escrow officer at Fidelity, recommended a CPA or a tax accountant, and so I sent Jimmy over to Lee, and Lee was able to get Jimmy to the right people to take care of the situation.
And he had to get a TIN?
He had a TIN, and also it was something to do with his wife and so that they could file. They're going to withhold the amount of money because basically he made a lot of money in appreciation over these last 7 years, but they're still going to tax him on the entire thing, not just his profit. So,
oh wow,
yeah, that's what I was like, 33% or something like that. So they withhold that.
That's
and
a lot.
even though he paid money to buy the house. So anyways, I learned a lot, but I'm probably not explaining it correct, that well, but
The reasoning behind especially in that case, the reason behind the withholding is to make sure the person files a tax return. Especially if he's over, California started doing that when people, 15, 20 years ago, when we Californians would start selling our homes and move to Arizona and then not file a California tax return. So California started withholding and said, oh, okay. And then now that when they moved to Arizona, they're still filing a tax return to get the refund. And in that guy's case, that's a perfect example of what we just talked about the 1031 and having issues. I talked with him, or we emailed, like you said, his English was a little, but I could have done it. And I looked into it and I told him I could do it and I could it's going to take a little longer, or you can go with these companies that specifically do that. You're going to pay them more, and it's going to be quicker, and definitely, right. And I said that, and that's what I reckon. I gave up the revenue because I'd rather have him get it done properly on something like that. And it turns out I think he's going to come to me to do his tax return this year when it comes time to it, which wasn't my entire goal. My goal was to be of service, to help however I could. And to me, I thought, and he ended up. I gave him a list. I looked it up. I gave him a list of folks. I didn't know what cities were close to him, where he lived, or them, but I gave him a list of 5, I think, and he picked one of them, and he was very happy. He chose to go with them and get it done.
he was very happy, and he was, yeah, so, many thanks to you, and he's very appreciative.
So
yeah.
then we had the Proposition 13. We're changing subjects
Yeah.
again. Sorry. Proposition 13. We have 60. Now we have a couple new ones. Can you kind of enlighten us on I know.
Well, it's funny. I just got an email this morning from one of my CPE, continuing professional education providers, on Prop 19, and so I haven't taken it yet, but I have done some research. And what I know about 19 is the
where you can buy.
And you can transfer multiple times, up to 3 times.
Up to 3, as before it was just once, I believe, and it's like. So that's the basis, and what it was, I know the basis used to be only transferable in certain counties. They had 5. There were 5. I didn't know, but now it's anywhere in California. That's the one thing about it. And if the downside is that if a child inherits the property, and depending on what they're going to, if they move into it, make it their primary residence, they have an exemption of $1 million that they don't have to mark it up. But if it's a commercial property, a vacation property, or if they're going to use it as a rental property, then it goes immediately up to the current market value reappraisal, and that's what they pay taxes on. So that makes a huge difference in what they decide they're going to do with it, whether they're going to keep it or sell it. And the likelihood, depending on their cash situation, they would probably be selling it because their basis is going to be what it was at the date of death, or 6 months, depending on what so that's pretty much what I know about that one. So it's basically bad for kids or folks that are inheriting property. It's okay in the sense of transferring, somewhat to if you move into another property, maintaining the basis that you had. That's
Okay.
Well, that'll be interesting this year.
Yeah,
You know,
definitely.
and prices are at an all-time high, and if you leave this area and go to LA, and
Go to LA.
they can buy a more expensive house there.
Right, and then
Yeah.
transfer. Yeah,
Yeah.
so, because I was looking at the counties, and, Santa Clara cooperates, but San Luis Obispo doesn't. I think it was. They didn't cooperate with Santa Barbara County with that tax.
Oh, really?
Yeah, I was like, well, that's kind of, anyway, I won't get into that, but anyway, good information, and let's see.
The tax postponement too, you were mentioning that.
Yeah.
Because what made me think of that is you mentioned Santa Barbara and San Luis counties, and the reason that triggered something is because there's an extension of time for that. It's got to be done by, I think, February of this year, filed for, except they're giving extensions to a whole bunch of counties, but not Santa Barbara and not San Luis Obispo County. So probably any clients you have, there's no extension for it. And the thing about that, so it's like you can ask for, and I think the state controller will pay your taxes, your property taxes for you. But if you're 62 years, blind or disabled, your income is less than $45,000. It's your primary residence. You have at least 40% equity, and there's no reverse mortgage on it. But it's a loan. It's not free money. They're not paying it for you and saying, okay, you're good. It's a loan, and when you sell the house, they're going to take it out of escrow.
It's like a reverse mortgage.
Yeah. If you get a reverse mortgage, immediately due and payable. If you die, it's immediately due and payable. Not that you have any control over that, but if you get delinquent on any future taxes, and you have to reapply every year. You have to reapply every year. And so if you get denied in the second or third year and it's not, they don't pay it for you, and then you go delinquent on those taxes, then all the ones previous, assuming there were any, are now due and payable. So remember, it's a loan. It's not really free money, definitely, but in the time value sense, or if in the sense of until you sell it, because if they're in low income and they're 62 years old and $45,000 or less, there might be benefits to them for doing that. Yeah.
You might need that assistance.
Yeah, but the extension February 10th, I have it written down. February 10th is the deadline for this year, and it's getting extended to June. But I don't remember the date, June whatever. But it doesn't matter for us because it's not in Santa Barbara and it's not in San Luis Obispo. For us, it's February 10th of this year. So.
Oh, that's
More dates.
interesting.
Okay.
Very good. Well, my goodness, thank you for all this great information, Lee. Can you think of anything you'd like to add to maybe help someone give them some information that we didn't cover?
No, I mean, I think that home buying is important, and I think when some of it, when it came to finding the places and where to go, I'd send them over to you guys. And if it comes to the time for if they have questions on taxes or whatever, then someone like me that can help. And I always tell my clients, let me rephrase it, not always, but oftentimes I'm like, well, why you should have called. Call before the transaction is completed. That's part of what my fees are all year, is to be there for you all year long. And so they make a decision on a property or something, what it might be a sale, a collectible or something, but they didn't call me first. So it's like always, and not all of us, we're not like, well, I don't want to say anything bad about attorneys, but I don't necessarily call. I don't charge on a phone call. I'll help if I can. My job, I want to be of maximum service to everybody as much as I can. So if we can help, we'll be there, just like you guys. So.
That's
Thank
great.
you.
We appreciate
That's
it.
awesome. Very good.
So if you have any other questions or you'd like to subscribe to see more information, go ahead and click on that button, and you can reach me at 805-714-8124.
And my number is 805-878-5056.
Thanks for watching.
Yeah, we'll see you soon.
Bye.
Thanks, Lee.
All right, thank you.